Last time, we put the dollar's rivals on a scale. The euro, the yuan, gold. We wrote down the job of a reserve currency and graded each one against it. Not one passed the whole test. But we ended on a stranger question. Every candidate we scored runs on the same 20th century plumbing. The same banks, the same networks, the same treasury market. That video asked which money might replace the dollar. This one asks, what happens if the form of money itself changes? China already has a digital yuan. Europe is building a digital euro. There is a name for this new kind of money, a central bank digital currency, a CBDC. And almost everything you have heard about it is either a warning or a sales pitch. One side calls it a surveillance leash. The other calls it just a faster app. Today, we do the calm thing in between. We explain what this money actually is, then walk the real trade-offs. Both sides, every time. Because a CBDC is not a prophecy. It is a set of design choices. And the interesting part is watching which choices each country actually makes.
Start with a fact that surprises almost everyone. The money in your banking app is not the safest kind of money there is. It is a promise. Money comes in a hierarchy. At the top sits central bank money, the safest, most final money that exists. It takes two forms today: physical cash, the notes and coins anyone can hold, and reserves, digital balances that only commercial banks may keep at the central bank. Central bank money is a direct claim on the state's monetary authority. It cannot fail because the central bank issues it. Below that sits commercial bank money. The deposits in your checking account are not central bank money. They are a liability of your bank, an IOU, a promise to hand you cash on demand. It works because of deposit insurance and regulation, and it is the money we use for nearly everything. But structurally, it is private money, a claim on a company, not on the state. So here is what a retail CBDC does in its core form. It lets the public hold central bank money in digital form, a direct claim on the central bank, like digital cash. Today, you can only hold that safest money as physical notes. A CBDC would add a digital option. That one change is the whole story.
Now, what a CBDC is not, because the word digital hides three very different things. First, a CBDC is not cryptocurrency. Bitcoin runs on a decentralized network, with no issuer, no authority, nobody's promise behind it, and a price that swings. It was built to remove central banks from money. A CBDC is the reverse, maximally centralized and sovereign, run by the very kind of institution Bitcoin was designed to route around. Second, a CBDC is not a stablecoin. A stablecoin is a token issued by a private company, which promises to back each coin one for one with reserves like dollars and short-term government debt. It is a private IOU dressed as digital cash, not state money. Hold on to that. It matters enormously when we reach the United States. So, three trust models wearing the same coat. A CBDC is state money gone digital. A stablecoin is private money pegged to a currency. Crypto is money with no state at all. Which one you mean changes everything. And one more thing. A CBDC is not automatically the end of cash. The central banks proposing these systems say a digital version would complement physical cash, not abolish it. Add an option, not remove one.
There are two very different animals under one name. A wholesale CBDC is digital central bank money for banks and large institutions to settle payments between themselves. That one is barely controversial, an upgrade to plumbing the banks already use that the public never touches. A retail CBDC is digital central bank money for ordinary people, for everyday payments. That is the controversial one. Every privacy question, every bank question, every control question lives here because it puts central bank money directly in ordinary hands. So the whole heated debate is really about retail. Say that, and much of the confusion dissolves. Now, why are central banks looking at this at all? Here is that case, in their own terms. First, payment efficiency and resilience. A public rail that is cheap, fast, always on, and a backstop if private networks fail. Second, financial inclusion. Reaching people without bank accounts, sometimes with just a phone. Third, monetary sovereignty. As foreign digital currencies, big tech apps, and private stablecoins spread, a central bank may want a public option, so its citizens aren't forced onto someone else's rails. That is Europe's most stated reason for a digital euro. And fourth, cheaper cross-border payments. Every one of those motivations is real, and everyone comes attached to a hard trade-off.
So let's walk those trade-offs, the genuine, unresolved ones. We start with the hardest, privacy. And it has 3 parts. You need all 3. Part 1. What is simply true? Physical cash is anonymous. When you pay with a banknote, there is no record of who paid whom. Any digital money leaves a record. So a retail CBDC could, depending on its design, create a far more traceable trail of everyday payments than cash. That is not paranoia. Part 2. What the central banks actually propose. The major designs are built to limit exactly this. The European Central Bank has said that for a digital euro, it would not see users' personal transaction data. That identity would be handled by intermediary banks, not the central bank itself. The design includes an offline mode for small payments, with privacy close to cash, and protections written into law. Part 3. What is still genuinely open? Whether those safeguards are strong enough, whether they would survive a future change of law, and how much any state should be able to see in principle. Notice what this is. Not a decided dystopia, not a solved problem either. It is a real, unresolved design choice, and reasonable people land in different places on it. That is the honest frame, not a verdict.
The next trade-off is about ordinary banks. Banks lend out the deposits you keep with them. Now, imagine holding perfectly safe central bank money directly instead. In a panic, people could pull deposits out of banks and into the CBDC, a bank run made easier. And in calm times, if too much money sits at the central bank, banks have less to lend, which can raise the cost of credit. The main proposed answer is a holding limit, a cap on how much CBDC one person can hold, so it works as a way to pay, not a vault that drains the banks. The European Central Bank has discussed limits in the low thousands of euros, and such designs usually pay no interest. Whether a limit can be high enough to be useful, yet low enough to protect banks, is a genuine open question. Then the most charged trade-off, programmability. A digital money could, in principle, carry rules, money that expires or can only be spent on certain things. Critics warn that is a lever for control. Proponents call the same feature a tool, automatic payments, or faster benefits. And the central banks in front here have said the core digital euro would not be programmable in that sense, precisely to avoid the concern. The technology enables it. Whether it is used and how far is a choice each design makes.
So who is actually doing this? Treat these numbers as of the latest reading. They move, and we have dated them. Close to 150 countries and currency unions. Together, more than 98% of the world economy are at least exploring a CBDC. A few years ago, it was a handful. But here is the figure that matters just as much. Only 3 have truly launched a retail one: the Bahamas, Nigeria, and Jamaica. And all 3 have seen slow, modest uptake. Near universal interest. Very thin real-world adoption. That gap is the story. Then, the biggest experiment of all. China's digital yuan, the e-cny, the world's largest live pilot. Over about 5 years, it has processed the equivalent of roughly $2.3 trillion in payments, an enormous number. And yet,
that is still only a fraction of 1% of China's total payments. The country runs on private apps like Alipay and WeChat Pay. A big headline, a small share of daily life. And late in 2025, something telling happened. China reportedly redesigned the e-cny toward what is called a digital deposit model, moving much of it onto commercial banks' balance sheets to keep it from draining bank deposits. By many analysts' reading, that change means much of it may no longer be a true CBDC in the strict sense. Even the biggest experiment on Earth hit the same bank trade-off we just described, and quietly stepped back.
Now watch 3 of the biggest economies answer the same question 3 ways. China, as we saw, built the largest experiment and is now reworking it. Europe took the careful, deliberate path. Its central bank spent 2 years on a preparation phase and, in late 2025, decided to move to the next one, building toward a possible digital euro. Notice that word, possible. It is not a decision to issue. It still needs a law, passed by Europe's lawmakers. On the central bank's own working assumption, if they approve it, a first issuance might come perhaps not before the end of the decade. Careful, conditional, and put to a vote. And the United States took the opposite road entirely. In early 2025, an executive order directed that U.S. agencies may not establish, issue, or promote a central bank digital currency, on the stated rationale of protecting financial privacy and the private sector's role. Later that year, a law known as the Genius Act created the first federal rulebook for private stablecoins, requiring full reserve backing and regular public disclosures. So the American answer to digital money is not a public CBDC at all. It is regulated private stablecoins. As of today, the United States has no retail CBDC, has legally prohibited one, and is steering toward private digital dollars instead. 3 of the biggest economies, 3 different answers. So let's pull it together. 2 facts sit side by side, both true. Nearly the whole world is studying this, and almost no one is actually using it. Studying a thing is not the same as the world running on it. And the trade-offs we walked, privacy against traceability, the risk to ordinary banks, programmability as tool or control, none of them has a settled answer. Different central banks are placing different bets right now. That is not a countdown toward one outcome. It is a live experiment, run in public. Which is why the honest question is not when a CBDC takes over. It is which design choices each country makes. And the answers genuinely diverge. A CBDC could stay niche, a quiet, wholesale upgrade to bank plumbing you never see. It could slowly become normal infrastructure, the way tap-to-pay cards did. Or the model that spreads could be the American one, private stablecoins filling the role, with no public CBDC at all. All 3 are live. Anyone who claims to know which wins and when is guessing. The thing that decides it has not been decided. It is not destiny, it is design. And the real stakes are not some countdown to a cashless future. They are quieter and bigger. Who issues the money you hold? How private your payments are? And who gets to see or set the rules?
So, could a digital dollar, euro, or yuan rewrite the rules of money? The honest answer is that it depends entirely on choices no one has finished making. A central bank digital currency is a real, powerful idea. Central bank money, the safest kind, in digital form, that you could hold directly. And the very thing that makes it powerful is what makes it double-edged. The same feature that could make payments cheaper and reach the unbanked is what raises the hardest questions about privacy, about ordinary banks, about control. Right now, the world is split. China reworking the biggest experiment, Europe building toward a digital euro that still needs a vote, and the United States banning a public one to regulate private stablecoins instead. That is not one world marching toward a single digital money. It is a world trying very different answers. So watch the choices, not the countdown. One note, as always, this has been an educational analysis of the monetary system and public policy, not investment or financial advice. The figures are dated and sourced. And that leaves one last thread. Because while governments argue about public digital dollars, Private companies already built their own. Stablecoins, now worth hundreds of billions, and the United States just chose them over a public CBDC. So who really issues the digital dollars inside the apps on your phone? And what happens to a currency when its digital form is run by private firms? That is where we follow the money next. This has been Money and Power Explained. Follow the money. It always leads to power.